without further ado, I'd like to introduce Jack Purdy from Masari.
Hello, everyone. Jack Purdy here. As Ryan mentioned, I'm a research analyst from Masari. I know you've all been asking yourself, when do they get into DeFi stuff? Well, I'm excited to kick off the late night session with a state of decentralized finance. So I'm going to start off with just generally, why does DeFi matter? And then look at some recent trends that we've been seeing in the space before going to a sector by sector breakdown, and then finishing off looking more forward as to what's to come. So why does DeFi matter? Well, I'm sure you've all seen this laundry list of properties on the left used to describe Bitcoin or crypto more generally. And Bitcoin was something new, something special, because it allowed you to hold, send and receive your money in a manner where you don't have to go through KYC. It's all transparent in that anyone can verify all these transactions. There's no third party that can step in and censor any of these transactions, which is all good and great. But the second you need to or want to go to more advanced financial transactions, say use that Bitcoin as leverage to take out a loan, or you're a trader and you want to lever it up, then inherently you have to go through trusted third party. So a Coinbase, a BlockFi, a BitMEX, which not in and of itself anything wrong, but it infringes on a lot of those properties that make Bitcoin what it is. So that's where DeFi comes into play. DeFi allows this plethora of money verbs to still uphold what makes crypto crypto. So you can trade, you can lever up, you can collateralize assets and create innumerable synthetic assets. Really, anything you can think of. There's a massive design space for thinking here. And so actually kind of bridging these two worlds, one of the biggest trends has been bringing Bitcoin onto Ethereum. And this is important because while Bitcoin remains limited in what you can do natively on chain, it still has the greatest product market fit in crypto as a macro asset, as we talked about on some of the other institutional panels earlier in the day. But so having this ability to now port it onto Ethereum, then it benefits from the massive ecosystem of financial applications. So it's the BTC on ETH has mostly been driven by WBTC, which is a pretty simple Bitcoin held in a trusted third-party custodian, BitGo, and then an ERC20 token is issued with one-to-one redeemability. And you may think, okay, well, that compromises having a non-custodial asset, which is true, but I can still pseudonymously acquire WBTC. And as of recently, I can lock it into MakerDAO Vault, take out a loan against it, still use these wide variety of financial applications. And if that's something where you still think I don't want to go through that custodian risk, well, there are other implementations out there like RenBTC as well as TBTC that are trying to trustlessly allow Bitcoin onto Ethereum so that you kind of get the best of both worlds. Another big trend we've been seeing is what I like to think of as the decentralizing of BitMEX. And what I mean by that is BitMEX really rose to prominence because of this. It pioneered the perpetual swap, which looks or kind of acts like similar to a futures contract, but doesn't have any maturity. And it's provided pretty much the easiest way to get leverage on Bitcoin, and for that reason is the most widely traded liquid instrument in all of crypto. And given there's such high demand for it, the DeFi ecosystem says, hey, let's port this into the world of DeFi. And so DYDX recently launched their BTC perp, and already they've had almost $40 million traded, which is pretty impressive. I mean, that includes, I think it was upwards of 12 million in one day, which is a lot more than most DEXs do in a single day across their entire spot market. So perps on DeFi are definitely here to stay. We're seeing a handful of other protocols implement something similar, like FutureSwap, Strike protocol, a handful of others. So that's definitely something to expect to continue going forward. Moving on, or I guess continuing with decentralized exchanges, they've really grown immensely so far this year, with nominal volumes increasing almost around 5x, and not only nominally, but as a share of total volume. And as you can see on the right-hand axis, it's still around 0.5% of the aggregate volume. So not taking a large share yet, but it's consistently eating into the share of centralized exchanges. And this has been reflected in the native tokens themselves. DEX tokens have been significantly outperforming centralized exchange tokens on just about every single asset, with one exception of OKCoin. But for the most part, all these tokens have appreciated significantly this year. And a big reason is they've undergone substantial upgrades recently. We saw 0x kind of started off towards the end of last year with their big V3 upgrade, which radically altered the token economics, instituting a staking mechanism to incentivize market makers to provide more liquidity on the exchange. And so far, it's done its job, and there's going to be similar upgrades coming with Kyber and Bancor implementing staking to have similar incentivization. Loopring was another one towards the end of last year. They moved all of their data and computation or storage off-chain, but still maintain this decentralized exchange property by implementing zero-knowledge proofs, which improved their scalability quite a bit, which has been one of the big reasons why traders have been hesitant to move from centralized to decentralized exchanges, given these inherent latency issues. And then Uniswap as well, that was more recent. There was a long-awaited V2 upgrade that introduced a whole bunch of new features, including ERC20, ERC20 pairs, flash swaps, which are kind of similar to flash loans, which have been gaining popularity, as well as new price oracles. So we got 3 more upcoming that are slated for the end of the quarter. So we got 1 month left, and those will be big stories to watch in the DEX space. Looking at credit markets now, the big trend I think that's important to watch is the interest rates that have been decreasing substantially after Black Thursday. And so Black Thursday, when crypto asset prices dropped 50% pretty much across the board, every leverage trader got wiped out. Liquidations were just insane that day. And ever since then, traders have been tentative to lever up, which has been pretty much the vast majority of crypto lending, where you're using ETH or Bitcoin as collateral and then borrowing stablecoins to rebuy it, increasing your overall exposure. And so since Black Thursday, rates have dropped substantially, and that was one of the big reasons people saw non-crypto people coming into crypto, because it's an easy apples to apples comparison of, you're getting 1.5% on your traditional savings account. Oh, move your dollars into this digital land and you can get 6, 7, 8%. However, that opportunity seems to have dried up. And keeping with that negative rate or low interest rates, MakerDAO, they dropped their stability fee to 0% amidst all this chaos in order to restore the DAI peg. And ever since that, they have gained an increasing share of the overall loans outstanding. And that's simply because secondary lending platforms, they can't compete with 0%. Their interest rates are determined algorithmically based on the utilization rate. So percent of loans borrowed to loan or money deposited. And so by definition, they can't go to zero, but the fact that Maker controls DAI and they have that ability to, people wanting to take out leverage are obviously going to want the lowest fee there. Looking at asset management now. So asset management is kind of this vague catch-all term, but I think in crypto, you can use it to mean protocols that look to provide means of investors deploying capital, but not having to actively manage it themselves. And so two big protocols to watch are Set and Melon within the asset management space. And I'll mention that this graph isn't used to compare the two, that there's dual axes here, but just more so to show the general growth in both of them. With Set though, they provided an easy way to utilize kind of like the tried and true trading strategies of take like a simple moving average trading strategy where you want to sell if the 20-day moving average goes above the price and then buy when it dips below, rather than having to actively manage that. This automates the whole process. You can just deposit your ETH and then have it trade based on that strategy. So it really just automates that whole process for you, and you can look and see if that is outperformed, back tested. You can try various strategies with that, as well as even like copy trade, more like active managers who think they're have some source of alpha. And Melon, while it's smaller on the gross scale, again, it's growing pretty quickly. They released a new Melon interface not too long ago that makes it easier to spin up a fund, where in the traditional space, it's a very time-consuming, expensive process to create an investable fund. But Melon really automates this whole process, and then managers can, set what their parameters are, what they're going to invest in, their fees, and then allow the whole investment universe to look at them, compare across various managers, and make their investment decisions from there. So looking out into the future, I think one of the biggest stories to watch is this trend towards gradual decentralization. Every crypto white paper seemed to mention, governance, like we'll do it eventually. We got this company that raises money, but down the line, like we'll figure it out. Well, we kind of seem to be at the turning point where projects are thinking, let's figure it out and see how we can have this protocol be driven forward by the broad set of stakeholders. So MakerDAO, one of the oldest and really most important projects within DeFi, they started and completed transfer of the MKR token to Maker holders this year, which was a big step, and then actually outlined a plan to dissolve the Maker Foundation, and then introducing a Maker improvement proposal process that you can think of like a Bitcoin BIP or Ethereum EIP, where the community has a governance mechanism to propose various changes, and then a path to have it actually be implemented in the code itself. And they recently completed their first full governance cycle, which is kind of marking like the start of like this new system. And Compound, another like similar lending protocol, they took a very different approach from the start, in that they were tokenless from the beginning, but had a plan to introduce it for the company to kind of seed control and then eventually spread it out to the network stakeholders. So they started reducing admin privileges last year, announced their token in Q1, and pretty quickly iterated on that and had community governance go live by distributing token to the company's initial stakeholders, so the team itself and investors. And then actually last week outlined a plan to more broadly release the tokens to people who are lending and borrowing from Compound over the next 4 years to distribute governance in a way where it's going to the people who are actually using it, which, as I mentioned before, Compound can't compete with Maker on 0% fees, but now with this interesting incentive mechanism, people might be more incentivized to borrow and lend from Compound, given that they'll get a slow trickle of Compound governance tokens, which could have value in the future. And lastly, I'd be remiss if I didn't talk about these like hacks and exploits that you're hearing a lot about, particularly this year. And that's because DeFi protocols pretty much act as this big honeypot of real financial value that is open for anyone to come and exploit it if you find a way. We saw that in 2016 with a big DAO hack, and still continuing today, and likely not going to end anytime soon, just given the nature of it. And what makes it so difficult is not only do you have to worry about smart contract bugs and messing up the code itself for an attacker to be able to come in and take money in these pools. The protocol can actually act completely how it's meant to, but there's various financial and economic means of exploiting it, whether it's through oracles and manipulating the price so that you can take out a loan, but have it be under collateralized based on like the real market price of that asset. And so we've even seen that. So for projects going forward, it's really going to be important to not only get these smart contract audits and make sure the audit's clean, but go through the financial economic means of seeing like how the different money Legos stacking on top of each other play into it and potentially create various attack vectors that could be exploited. And even going one step further on top of audits, providing tools like insurance or put options where if you think about the worst case happening, how can users still be protected? And so now there's tools out there that allow you to pretty much cover yourself in the case of a worst event to be able to recoup some of your financial loss you would have otherwise. And that is it. Thank you for listening.